Good morning, and welcome to this special update from USA Benefits Reports, where we deliver the latest and most critical information on government benefits programs to help Americans navigate their financial futures with clarity and confidence. As we find ourselves in January 2026, many individuals across the nation are logging into their bank accounts this morning, eagerly checking to see if their Social Security deposit has arrived, a routine that underscores the vital role these payments play in the lives of millions. In this report, we aim to provide a comprehensive overview of the recent changes implemented by the Social Security Administration, changes that have fundamentally altered the rollout of payments and that impact over 67 million Americans, yet remain largely under-discussed in mainstream conversations. It is essential for beneficiaries to understand these shifts, as they directly influence when funds are received and how much net income ends up in their accounts after adjustments. For those born between the 1st and 10th of any month, today marks the day their payment is scheduled to land, aligning with the second Wednesday of the month under the new scheduling framework. However, beyond the timing, there is a broader context that demands attention, including the cost of living adjustment for this year, which stands at a modest 2.5%, representing the smallest increase observed in the past 4 years. This adjustment translates to an average boost of approximately $48 per month for retirees, a figure that might initially seem like a welcome addition, but one that requires closer examination due to offsetting factors such as rising Medicare premiums. In the following analysis, we will methodically walk through the intricacies of these payment schedules, the implications of the cost of living adjustment, and the 3 key verifications every beneficiary should perform immediately to ensure they are maximizing their entitled benefits and not inadvertently leaving money unclaimed. Starting with the core mechanics of the payment distribution, the Social Security Administration has long relied on a structured schedule tied to an individual's birth date to manage the disbursement of funds efficiently. This system is neither random nor intended to create confusion, though it often does generate questions and concerns among recipients who have dedicated decades of their working lives to contributing to this program. For clarity, if an individual's birthday falls between the 1st and the 10th of the month, their Social Security payment is deposited on the second Wednesday of each month, which, in the case of January 2026, is today. Those born between the 11th and the 20th can expect their funds on the third Wednesday, while individuals with birthdays from the 21st to the 31st receive payments on the fourth Wednesday. This staggered approach was originally devised to distribute the administrative workload across the Social Security Administration and banking institutions nationwide, particularly in an era when physical paper checks were the norm and a single-day influx could overwhelm the system. Today, in 2026, with the overwhelming majority of payments occurring via direct deposit, the process is far more streamlined and rapid, allowing funds to transfer electronically from federal coffers directly into personal checking accounts with minimal delay. This evolution represents significant progress, enabling quicker access to benefits and reducing the uncertainties associated with mailed checks. But it also means that any discrepancies or issues, such as account errors or processing hiccups, become apparent almost immediately, heightening the need for vigilance among beneficiaries. There is, however, an important exception to this birth date-based rule that applies to certain groups, ensuring their payments follow a different cadence for historical and programmatic reasons. Specifically, if an individual began receiving Social Security benefits prior to May 1997, or if they are recipients of both Social Security and supplemental security income, their payments are issued on the 3rd of every month, irrespective of their birth date. In instances where the 3rd coincides with a weekend or a federal holiday, the deposit is advanced to the preceding business day, a provision designed to prevent interruptions in access to funds during non-banking periods. Understanding this exception is crucial, as it affects a subset of beneficiaries who might otherwise anticipate payments aligned with the general schedule, and overlooking it could lead to unnecessary anxiety or misplanning of monthly finances. Moving deeper into the financial implications, the cost of living adjustment, or COLA, for 2026 merits detailed scrutiny, as it directly shapes the purchasing power of benefits amid ongoing economic pressures. Announced at 2.5%, This adjustment is indeed the lowest in 4 years, prompting widespread discussion among retirees and advocates about its adequacy in keeping pace with inflation. To contextualize, the average Social Security retirement benefit in 2025 stood at roughly $1,176 per month, and applying the 2.5% increase yields an additional approximately $49, though earlier references have rounded this to $48 for the average beneficiary. While this increment might appear as a positive development on the surface, it is imperative to consider the interplay with other mandatory deductions, particularly those related to healthcare coverage, which can substantially erode the net gain. A prime example is the rise in Medicare Part B premiums, which are automatically withheld from Social Security payments for enrolled individuals, effectively reducing the take-home amount. For 2026, the standard Medicare Part B premium has increased to $185 per month, up from $174.70 the previous year, representing an additional burden of about $10.30 monthly. This escalation means that for many, the celebrated $48 COLA boost is partially or even largely offset, leaving the net deposit in their accounts with only marginal improvement, if any. Furthermore, premiums for Medicare Part D, which covers prescription drugs, have also risen for most plans, though the exact amount varies based on individual coverage selections, adding another layer of complexity to budgeting. This dynamic illustrates a broader reality within the benefits ecosystem. While the government provides adjustments to account for rising living costs, simultaneous increases in associated healthcare expenses can diminish the effective value, a phenomenon often described as the government giving with one hand and taking with the other. Beneficiaries are encouraged to calculate their net payments meticulously, focusing not solely on the gross benefit amount communicated by the Social Security Administration, but on the actual funds deposited after all deductions to gain a true picture of their financial position. Another underappreciated change this year pertains to the earnings limits for those who continue working while receiving Social Security benefits before reaching their full retirement age, a scenario that affects a significant number of Americans balancing employment and retirement income. For individuals who have claimed benefits early, that is, prior to their full retirement age, which is 67 for most current beneficiaries, the 2026 earnings limit is set at $23,640 annually. Earnings exceeding this threshold trigger a withholding of $1 in benefits for every $2 earned above the limit, a mechanism intended to align benefits with ongoing work income. For those approaching their full retirement age within the year, a higher threshold applies at $62,260 for the months leading up to that milestone, with withholding occurring at a rate of $1 for every $3 over the limit. It is important to note that these withholdings are not permanent penalties. Rather, the Social Security Administration recalculates and increases future benefits upon reaching full retirement age to compensate for the deferred amounts, ensuring long-term equity. Nonetheless, the immediate impact is a reduction in current cash flow, which can pose challenges for those relying on benefits to meet daily needs. Many individuals in their 60s who remain in the workforce do so out of necessity rather than preference, driven by insufficient savings, early claiming decisions, mounting medical expenses, or obligations to support family members such as children or grandchildren. This creates a precarious situation where additional earnings intended to bolster financial stability instead result in temporary benefit reductions, underscoring the importance of awareness to avoid unexpected shortfalls. To mitigate such risks, proactive steps are advisable, including consulting with financial planners or using online calculators provided by the Social Security Administration to forecast the effects of continued employment on benefits. Turning to practical actions that beneficiaries can take today, accessing one's personal records through the official Social Security portal is a fundamental recommendation, even for those who may be hesitant about technology, as this is the standard method in 2026 for managing benefits information. By visiting ssa.gov and establishing or logging into a My Social Security account, individuals gain visibility into their payment history, current benefit amounts, and complete earnings records, all of which are essential for verifying accuracy. Particular attention should be paid to the earnings record, as discrepancies arise more frequently than commonly assumed within this vast bureaucratic system handling hundreds of millions of entries. Errors might stem from employer reporting mistakes, such as incorrect Social Security numbers or omitted years of work, leading to understated benefits. Correcting these can result in substantial increases, with some cases seeing monthly payments rise by hundreds of dollars, representing funds rightfully earned through years of contributions and taxes. This verification process is one of the 3 critical checks emphasized in this update, empowering users to safeguard their entitlements. Additionally, for married individuals or those divorced after at least a decade of marriage, exploring spousal or divorced spousal benefits is vital, as these may offer higher payments than those based solely on one's own work history. If a spouse or ex-spouse had significantly higher earnings, eligibility could extend to up to 50% of their full retirement benefit, without impacting their own payments or requiring their involvement. Similarly, survivor benefits for widows or widowers can provide up to 100% of a deceased spouse's benefit, but these options are not automatically applied. Beneficiaries must actively claim them through the Social Security Administration. The agency does not proactively notify or adjust for these higher amounts, as it operates within defined rules rather than as a personalized advisory service, placing the onus on individuals to educate themselves and initiate applications to secure what they deserve. This advocacy is crucial, given that overlooking such benefits could mean forgoing thousands of dollars annually. Addressing broader concerns about the program's sustainability, projections indicate that the Social Security trust funds may be depleted around 2034 or 2035, potentially leading to a 23% reduction in benefits if no legislative interventions occur. However, this does not equate to the program's collapse. Ongoing payroll taxes would still support approximately 77% of scheduled payments, providing a baseline continuity, though far from ideal. Congress faces the imperative to act, possibly through measures like elevating the payroll tax cap, raising the retirement age, or revising benefit calculations. Actions delayed despite long-standing awareness of the issue, reflective of political complexities. For individuals, the focus should remain on controllable elements, recognizing that Social Security typically replaces only about 40% of pre-retirement income for average workers, and less for those with inconsistent or lower-wage careers. Over-reliance on this single source heightens vulnerability, necessitating diversified strategies including personal savings, investments, and alternative income streams to achieve a more secure retirement. For those already in retirement finding benefits insufficient, practical adjustments may include part-time work, mindful of earnings limits, downsizing living arrangements to cut costs, or relocating to areas with lower living expenses. Decisions that, while challenging, can preserve financial independence. A related consideration is the timing of claiming benefits, with many opting for age 62, the earliest eligibility, due to immediate needs, fears of system instability, or lack of awareness, yet this choice permanently diminishes payments by up to 30% compared to full retirement age. Delaying until 70, conversely, accrues an 8% annual increase beyond full retirement age, offering a risk-free return superior to many market options. While not universal advice, factors like health status, financial urgency, or family longevity should inform decisions. Waiting at least to full retirement age often maximizes lifetime income for most. In conclusion, for those eligible today based on birth dates in the first 10 days of the month, confirming the deposit's arrival, accuracy, and completeness is paramount, encompassing the 3 verifications: earnings record review, exploration of spousal or survivor options, and net amount assessment post-deductions. This diligence ensures that hard-earned contributions yield their full value, fostering informed management in an inherently complex system. Stay tuned to USA Benefits reports for ongoing updates on these and other essential topics affecting your financial well-being.